Hey everyone, Chris Haddon, Jason Balin here for REI360.net and HardMoneyBankers.com. This is REI 360 Show, episode number 25. We've had a great run so far this year.
Absolutely.
Covered some awesome topics. We're starting to get into some more interviews, and we're going to keep it moving. We're having fun. We're covering good ground. So, today's topic is how to spot a bubble in the real estate market. We're not saying there is a bubble right now, but there are some certain bubblish sort of indicators, and we're going to talk about the things to keep your eye on, what to be careful for, to make sure that you're doing a good and profitable business for the long term.
Absolutely. So we'll talk about exactly what we're seeing in the marketplace, in our current market. A little bit about some signs related to what a market bubble could look like, and also, what you do, things to be aware of, things like that, just so you don't get caught in it. Sure. If a bubble does occur, which I don't think it necessarily is. We're in a bubble, but there are some signs indicating that. So obviously, our home market is the Washington, D.C. and Baltimore regions. So some of the examples we're going to use are around here. So in the marketplace, as we see, and you probably see as well, is a lot of the foreclosures have kind of filtered through. So a lot of the foreclosure process has been done, and now they're active, and investors typically are buying these foreclosures. They're either getting sold to an investor, although banks have been pretty smart and they understand that they can't just list a property for full market value that needs work, because they know a homeowner.
They know what they're doing.
They know a homeowner can't qualify for that. Years ago they did. They just threw everything on the market and then things would sit. It wasn't good for them. Right. But they know that they either have to sell it at a low enough price to an investor, or they need to go in, which they have been doing. I've seen even larger banks going in, doing some basic updates or maintenance so they can get it livable condition, livable for conforming loan purposes, so a homeowner actually can go in and buy the property themselves.
Right, so a retail buyer can get bank financing.
Exactly.
They get it to that kind of condition. Got it.
Exactly, and that's important. Then you can sell it for a little bit more. Short sales seem to be getting approved quicker than before. That used to be a long, drawn-out process. These days, sometimes
there probably just aren't as many of them. There probably just aren't nearly the volume.
Yeah, and they're able to kind of filter through. So there's definitely inventory on both sides. There's inventory for real estate investors to go and pick up at a discount to buy, and there's also some inventory of nice livable properties for homeowners. And I would probably say that the nice renovated houses, part of where we're going to get to next related to signs of a market bubble is, there's competing real estate offers out there again. Nice renovated houses that investors are coming in and picking up, they're putting on the market, and the next one's getting sold for higher than the next and the next and the next and the next. So we see that obviously a lot in the Washington, D.C. market and the Baltimore market. That's pretty much all over. That's just where we're using an example for, the purposes of the show. What else do we see out there that's kind of currently in the marketplace? I mean, it's really a good market for all parties. And I think a lot of
what I was going to say
goes back to interest rates being low as well.
We'll get into that in one sec. But in general, would you say the market's at about a 5 out of 10? Like one is way, buyer's market, the other one's seller's market, and we're somewhere in the middle? You can sell your property?
I think we're probably higher than that.
Okay,
I'd
so
probably
it's
say
more of a seller's market. It's more of an 8 out of 10. You'd rank that.
It's a seller's market for good inventory at priced right. What we see for the properties.
8 out of 10 is high.
Yeah, it is high. For properties that we're seeing on the market that are not selling quickly, or ones that people are just putting ridiculous prices out there. So like in a $200,000 area, they're saying, hey, the market's good right now, interest rates are low, I'm gonna list this thing at $249 and see if I can get this thing sold.
Yeah, or if it's not in the right condition. Buyers aren't just buying anything they can get their hands on. You know what I mean? It's not that crazy high.
Not at all. Not at all.
Okay.
So you have like the investor stuff, or then, with equity built in, or you have the homeowner stuff. And there's demand for nice inventory for homeowners. Yeah. There's not that much of a demand, for, I'm going to get 5% equity and I have to live in this kind of crappy setup right now.
Right.
But if it's a nice renovated property, people are paying a premium for it.
Yeah, and we're seeing some, like in the retail buyer market, some price escalations.
Absolutely.
Nothing crazy. Not like when it was, bubble times in 2005, 6. Not like that. But we're seeing competing offers and some, waiving this contingency in that one.
That's right.
That is happening, especially in, some of the higher dollar areas here in our market. You touched on interest rates for a second. You want to dive into that?
Yeah, I mean, interest rates are still obviously very good. If you talk to a lot of people, they say they're high, they're creeping up, but relatively they're still very low.
Super.
But as they creep up a little bit, the affordability of a homeowner or an investor alike, changes. changes. There was an example that we had in place that you can buy a $100,000 house with 4% interest rate, and your monthly payment is pretty much the exact same as an $80,000 house at a 6% interest rate. Mm-hmm. So it's a good way to kind of look at that. And the rates are kind of creeping up a little bit, so meaning the affordability factor will be affected.
Yeah, and that could be a good thing to avoid a real bubble occurring, is that market could cool a little bit as interest rates creep up, which has started to happen.
Cooling is probably the right word. So cooling. It's and not hot, not cold. Probably not hot, cooling not cold. is the right way to do it.
And I really think that's where all industry people want it.
Yeah, they want it cool. They want it stable.
Like we want a solid market. Yeah, they don't want anything wild on either end.
We want a market that's like this.
That's a real estate supposed
not
to
like
be.
this, and this. We want a market that's like this. And believe me, I mean, just because you don't have there's still opportunity if there's a market that goes like this and this and this, but you got to play that market a little bit better than just kind of sitting there. So those are all kind of signs of the market bubble. Obviously, sometimes there are competing offers. It's a seller's market. A big thing right now also is, which I hate that this is like this, but availability to money from banks. And we can touch on this a little bit because I kind of rave about this all the time, that banks kind of dictate the entire real estate market because they provide the liquidity into it. And although you can use private means or cash or private money for deals as a homeowner or investor,
right,
you're based on what the bank can give you on a deal.
Yep.
That's just what it's about. And FHA's back. I don't know what the stat is on that, but I think it's like 40% of home mortgages now are FHA.
Nationwide. I could see that nationwide.
Something like that, and that's not what it used to be at all. So, and with FHA, a lot of them are no down payments, or low down payments.
Payment, yeah.
I mean, one of our borrowers was telling me a few weeks ago that they sold a property and the guy brought zero money to close. And I mean, we come from an industry and a background, a consumer background, which is sad to say, but they will literally lever up everything that they have, and they don't buy. Sometimes consumers don't buy what they can afford. They buy what the bank will give them, what they can qualify for. So all of a sudden,
qualify for that? Sure, I'll buy it.
I mean, how many people do you know that live way above their means or have mortgage payments more than yours that probably make less money than you do? Right. That's just what occurs because the bank's telling them or giving them. And I'm not going to discredit the bank and say you have a bad model, because I think it's probably a decent model. But that goes back to consumers being responsible and doing the right things. But because now that there are lower down payment products, and you can buy a $200,000 house for $200,000 and you can fully lever it up, you have no cushion if something goes bad. And chances are, you can probably slide one by that you're buying a $200,000 house for $250,000 and getting full leverage on it. Depending on what bank you're going to. So those are all things that concern as like a market bubble. What I've seen directly and this is not like a stat, this is like what we see directly in areas of Washington, D.C., is there's areas that have appreciated 200% to 300% on properties that we've done loans for $200,000 in 2010, and then in 2012 we did a loan in the exact same property for $300,000, and today we probably do a loan on it for $400,000 or $500,000.
Right.
And that is, that's something that like internally we've seen that data, and it's absolutely crazy, but that's just how it is. And that could just be it's a new area and it's a booming area. But that's a lot of places. That's not just like a neighborhood.
That's not a neighborhood, but that's what has been happening, like in DC Metro, or specifically in the district, specifically in the city, where those areas are up and coming and gentrifying and like going up in value.
Yeah, but see what happens is you move an area like that and people want to move in there, and then like a next neighborhood down gets moved, replaces the current spot. So you have a Columbia Heights that's worth $500,000, it was worth $100,000 10 years ago, but $500,000 a few years ago, then it goes to 600 or 700, and then what comes next? It's like, oh, cool, well, I can't afford it at Columbia Heights, I'm going to take the next best thing, which is Petworth, which is $100,000 less.
Right.
So Petworth goes from 300 to 400 to 500 to 600. So
that has happened.
They all follow.
And those areas are more bubble-ish than the rest of like the metro area, for sure, much more.
Yeah, so those are kind of things, and again, like in my opinion, that gets capped out based on affordability of all of a sudden, we were median housing price neighborhoods. Now we're in the upper housing price neighborhoods, and there's only so many people that can qualify to be up here, so that's going to cap it off.
Right.
And that's kind of an extreme case, but it's real life stuff, and it's stuff that's got to be aware of.
Yeah, definitely the kind of thing that you need to keep your eye on, whether you're in the retail world and as an agent or mortgage lender, or definitely in the investor space too. You got to know what you're buying. You got to know what your future is. You got to know where that appreciation is going, or if it's going to cap off, or what's going to happen with your rental income. That too.
Sure. Let's talk about kind of things to not necessarily be aware of, but stuff to act on. So if a bubble does occur, you don't really get stuck at the bottom.
Okay.
And you can get yourself out of this. And typically, from all the real estate investors that we know, the ones that got hurt the most, and this is for homeowners or real estate investors, but the real estate investors that got hurt the most were the ones that were in I like to call a floating inventory period. So they have 10 properties that they're trying to flip, and they go to try to sell them, and the market explodes, implodes, I should probably say, and they can't find anybody to buy them. They have people that want to buy them, but they can't get financing. The homeowner can't get financing because of banks. So that's part of it. The other side is okay, cool, well, no problem, I can't sell them, I'll just rent them. Well, okay, well, the bank doesn't want to give me money either to rent them. Right? Because they're not doing loans. They're holding tight on their loans. So all of a sudden you're stuck with this inventory that you can't do anything with.
Right.
And
you can't refinance it, you can't sell it.
Exactly.
Because there's no bank money for it.
Exactly.
And then it just goes down, 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 down.
Yeah, and then you kind of scramble and do whatever you can, and it's manageable on a little bit of inventory, but if you're a big company or you're a home builder, it's hard to do that with.
Right.
Okay, so that's what investors, I would say a little bit of advice related to an investor is just, in case something like this does occur in the future, is, have some equity in a property to begin with. So you have a little bit more options. And equity can come from putting cash into a deal, or, buying a property and putting 20 or 30% into the deal as cash, or or having built-in equity, obviously, buying a property at a discount. It's probably a little bit of both, but, if you have a 10%, if you're leveraged up at 90%, you have 10% equity cushion, bubble doesn't have to burst for you to be in trouble. You have a little market twitch and you're in trouble with 10% of equity. So if you have 30% equity and you're responsible that way, it's a lot of people always just want to, like we talked about, lever every freaking thing up to a hill. But why not have a good amount of equity in each one, and then if you have to unload them, and it takes a little bit longer time, there's outs. So that's the one thing with investors. Homeowners, the same thing, like we talked about earlier. Just because you can, just because on paper you can afford, a $3,000 a month payment, and you can get a $500,000 mortgage and get $500,000 on a property. Put money down on it. It's a hard asset, right? I understand that interest rates are low, so a lot of people say, well, why would I put any money down into my property if I'm getting money lent to me at 4% because it's so cheap? But at the same time, you're right, it is. But especially if you have a short-term game plan, like I may be moving in 5 years, you don't know where the market's going to be. If it's a long-term game plan, you're going to be in the house forever, which you probably won't be because shit changes.
In that case, real estate's always fine.
Yeah.
A long enough horizon, a long enough timeline, then you're always fine in real estate.
Exactly. But you know damn well that Northern Virginia, who got killed the most, is back a lot higher, and it was either a straight asset or a straight liability. For somebody who had a long-term debt on that property for a long period of time, they are in an extremely good position. On the and their neighbor's house filed bankruptcy because they didn't have some sort of long-term plan on it. So stuff happens. All aware of it, and just one of those things to just be aware of, and play your cards right type of thing.
For sure. Okay, so to recap, we do not think it's super bubbly out there, but there are some signs. There's certain indicators. That's what we were going over. You be smart, keep your eye on things, and make sure to check us out. REI360.net, hardmoneybankers.com. You can also search for things and comment about the show. # the REI360 show, and we will see you next time. Thanks.